The year 2022 has been a wild year for the stock market with major indices all in the red, for the most part in double digit. Just to look at it, NASDAQ in the year ended the year at almost 33% down. For Russell 2000 index, it's down by close to 22%. The S&P 500 is down by almost 20%, and Dow Jones Industrial Average Index is down by close to 9%. Now, with that said, I wanted to take the moment to reflect on my own journey in the stock market and see how my own portfolio of dividend and growth investing through passive ETF investing has done in the year. Hopefully, it's going to be a point of inspiration for you. For those of you who have been following our journey, you know that I mainly have 6 high quality exchange traded fund in my portfolio, and I'm going to be quickly walking you through them, showing you how they have done in the past year in 2022, now that we are already at the end of the year. And later at the end, I'll be sharing exactly where my own positions are and what their return has been, and what's as well our plan for the year 2023, what we plan to do in the stock market in the next year, and how we are going to be continuing to invest. One of the main holdings in my portfolio is Vanguard FTSE Emerging Markets All Cap Index ETF with ticker symbol VEE. This ETF, in fact, over the past year has done very poorly. In fact, this is how this ETF has done overall. Not necessarily my position, but as a whole, it's, as you notice, year-to-date return is down by close to 16%, or 15.8 to be exact. The other holding in our position is Vanguard S&P 500 Index ETF, which is traded in Canadian dollars through Toronto Stock Exchange, but allows us to get exposure to the S&P 500 largest US companies. And you notice that this one as well, VFV, has done poorly for the year with 13.7% down, a negative, close to negative 14%. Next is Vanguard All Equity ETF portfolio with ticker symbol VEQT, which allows investors to get exposure, geographically diversified, as well as diversified through different sectors, to investing in the stock market. This is considered to be almost like a all-in-one basket ETF, and for investors who just even own VEQT, they're already getting exposure to the entire stock market throughout the world for the most part, which is a wonderful choice. For us, we are pursuing investing in VEQT as part of our Smith maneuver. VEQT last year, in 2022, is showing to be down by close to 13.3%. Next, we have XIC, or Toronto Stock Exchange, the S&P Toronto Stock Exchange Composite Index, which gives investors exposure to the pretty much entire Canadian stock market. It's down by close to 12% for the year. There's also iShares Core MSCI East and Far East Index ETF, which is showing to be down by close to 13% for the year. Lastly, we have Vanguard FTSE Canadian High Dividend Yield Index ETF. It is down by 7.38%. These are all the major 6 index fund ETFs that we have in our positions. With that, I'm going to walk you through how our own portfolio has done. This is the investments that we have between myself and my wife. In total, we have invested $389,416 in terms of the cost basis, that how much we've put in. In terms of the total value of this portfolio at this time, it is sitting at $377,749, or down by $11,668, or pretty much down by exactly 3%. Now, some investors might be seeing this and reflect on how terrible this portfolio has done. But I'm looking at more of a brighter side of the story. As I showed you early on, all the major indices in the market have done very poorly in the year. All these funds specifically that we are also ourselves invested in have also done very poorly for the year. But because we've been able to kind of invest in them over time, through the power of dollar cost averaging and at different entry points, we managed to kind of have much better returns, in comparison, relative comparison. So you'd see, for example, our overall return is only down by 3% compared to all the double-digit, mostly negative returns that I talked to you about. And in fact, we have some of the funds that are still positive. For example, with VFV and VDY that my wife has invested in. Those are still in positive territory. In this portfolio, as I want to showcase for you here, these 6 funds we've combined them together. You notice the largest position that we have belongs to VDY, which accounts for 43% of our holdings. We are invested with the current market value of $163,645 in VDY. It's one of the funds that also does pay a nice dividend, hovering around that 4% mark. With overall funds for VDY between my wife and I being only down by 1.1%. The next big holdings that we have is actually, now the order has changed, and it currently belongs to VFE. We have 927 shares of it with a total market value of $85,442, or accounting for 23% of our positions. It's still slightly up in total by 0.2%. VEQT is the third large holding that we have, close to 22% of our positions. It is down by 10.5%. VEQT, we started this position long ago. In fact, almost about a full year ago, around December of last year, compared to many other holdings that we started more recently to add more aggressively to them. As a result of that, VEQT, majority of the losses are actually reflected in early buys that we did close to December of 2021, and since then, as you saw, VEQT overall has done very poorly, and that's how it's actually dragged down our performance as well. But we are not worried about that. In fact, as we are paying down our mortgage faster, we are planning to reborrow those equity in our home and use that to buy more shares of VEQT. On top of that, VEQT is expected to pay us a nice juicy dividend in the new year. Usually it's paid in early January. We are going to be taking the entire dividend amount and repurpose and reinvest it and buying more shares of VEQT itself. Our fourth largest holding is 𝗖𝐋𝐈𝖖, which 624 shares we have, around 5%. Following that very closely is shares of V, which again is 5%, or we have 593 shares of that. Lastly, we have 𝗋𝐈𝐖, which actually currently accounts for about 2% of our portfolio. We still haven't been able to sell our shares of Bank of Nova Scotia, but they're sitting there until they hit the break-even point. One thing you notice is that majority of the funds that we have here pay on a quarterly basis their dividends. We have some that pay, actually one that pays on a biannual, one that pays once a year, and one that pays every month. In fact, VDY. But the common factor here is that all of them are going to be paying us the dividend in January, which is why we expect that the amount of dividend income that we're going to collect in January is going to be way higher than this average monthly dividend amount. As an example, the VEQT only pays its dividend once a year. Hence, we're going to be expecting a large amount of dividend coming to us in January. I will definitely be making a video later in January and providing an update of how much dividend income they earned in that specific month. Currently, as it stands, our portfolio is expected to earn us average amount of annual dividend equal to $10,900, just shy of $11,000 in dividend income, which is just remarkable. That averages out about $908 per month, or averaging about $30 per day, which is just incredible. And we are very fortunate with that. At the onset of the video, I also talked about how I'll be sharing with you my plans for investing in the stock market in the new year. What our goals are in the new year is to continue to aggressively invest in the stock market, mainly through these 6 ETFs that we have here. Now, when it comes to our geographical exposure, we've just done some adjustments here. Currently, with our plans, we would like to bring our target exposure to around 40% exposure to Canada, 40% exposure of investments in US, and about 20% to international markets. We'll see how that pans out. From the sound of it, we have to more aggressively invest in international and the US ones, just to bring our current exposure breakdown to closer to that of target. And for Canada, we have to slow it down just so that the rebalancing is done throughout the year. That's where we want to aim and get to in the next several months. As I indicated, the plan is still to invest into these high quality ETFs, as long as it helps us bring us closer to those target exposure breakdowns. In terms of the dividend and growth, really, as you notice here, this portfolio consists of both dividend paying and growth oriented ETFs, which is a nice balance for us. Well, it is nice for us to have investments in high quality dividend paying ETFs. It's also good to consider getting some exposure to more of a growth-oriented funds, such as the VFV or, for that matter, potentially 𝐻𝐈𝐖𝐊, that are not necessarily the highest dividend payer, but rather more so focused on some of that growth that comes from the index itself. We're going to make sure to stay financially disciplined throughout the next year as we earn our incomes from side hustles, from our day-to-day jobs, and all of that, making sure that we save aside enough funds for our emergency funds, but also in the meantime using the remaining balance wisely to invest them in the stock market month in and month out. And for those of you who are interested to see how that actually plays out and how we are able to use that financial discipline to our advantage, be sure to follow our journey here on Momentum Finance. We post every week about investing in the stock market. We also provide these updates on how our portfolio is doing regularly, so you can actually be sure to see how our decisions that we are making here is playing a part in terms of building a brighter future for us, helping us to put us on track to accumulating and generating wealth, as well as getting us ready for reaching that level of financial independence, financial freedom in the years to come. Thank you so much, everyone, for watching the video until the end. I hope you all have a fantastic year-end holidays, and I wish you all a wonderful new year. Thank you, and I hope to see you all next year.